Okay, well, good afternoon. Thanks to the organizers for inviting me to speak on this distinguished panel. I know many of you in the audience are familiar with the Federal Reserve's responsibility for setting monetary policy in the United States. Less well known is how the Federal Reserve System is structured to carry out all of its responsibilities to support the economy and the financial system. So before I share my views on the outlook for the US economy, let me give you a brief Fed primer. And as always, the views I express today are my own and not necessarily those of the Federal Reserve System or my colleagues on the Federal Open Market Committee. The Fed is a decentralized public-private system uniquely capable of serving the United States' economic and financial interests free from short-term political pressures. Monetary policy actions are undertaken by the Federal Open Market Committee, or FOMC, which is made up of the 12 Reserve Bank presidents and the 7 governors at the Board of Governors in Washington, D.C. The 12 Reserve Bank presidents rotate voting years, apart from the president of the New York Fed, who is a permanent voting member and vice chair of the committee. Whether voting or not, all 19 of us speak, listen, and learn from each other at every meeting. Besides setting monetary policy, the Fed's main functions are promoting financial stability, bank supervision and regulation, consumer protection and community development, and supporting the US payment system. A quick note about our payments work. The Cleveland Fed is one of several reserve banks that supports the government's payment services. This includes collecting customs duties, among other duties, taxes, and fees, on behalf of the US government. Congress has given the FOMC a dual mandate to achieve maximum employment and price stability. To do this, the committee considers a wide range of information to assess how close or how far we are from these goals, and how likely the economy is to reach them. The Fed's decentralized structure allows each Reserve Bank president to bring their district's unique regional perspective and on-the-ground insights into the nation's monetary policy setting process. These insights are particularly important to me right now as I try to extract the signal from the noise in economic and financial data. I spend a lot of time traveling around the 4th District to gather these insights. The Cleveland Fed's region encompasses all of Ohio and parts of Pennsylvania, Kentucky, and West Virginia. It's historically part of the nation's industrial heartland with a strong manufacturing footprint. I was recently in Pittsburgh, a major steel-producing area where the topic of steel tariffs is at the center of many conversations. Not far from Pittsburgh in the 4th District is Punxsutawney, Pennsylvania, famous for its annual Groundhog Day celebration. Lately, I've been feeling a little bit like Bill Murray's character in the movie Groundhog Day. For Phil Connors, Bill Murray's character, every day begins with his alarm going off to the song, "I Got You, Babe." Ned Ryerson inevitably tries to sell him life insurance. A blizzard forces him to spend the night, and he wakes up once again on February 2nd. Now, if you're a frequent follower of Fed commentary, you too may begin to experience a sort of deja vu. For me, most conversations I have with business contacts seem to hinge on the theme of elevated uncertainty, and each day I scan the economic releases for clarity in the data. So let me turn to what I'm seeing and not seeing in the data, and what I'm hearing from my contacts. In many ways, the US economy is maintaining solid momentum as we approach the middle of the year. Real gross domestic product edged down in the first quarter, but the combination of consumer spending and business fixed investment grew at a solid rate. The positive tone of the data, of the hard data, contrasts with a notable downshift in soft data since early in the year. Survey measures of consumer and business sentiment have declined, and many respondents have cited policy uncertainty. Looking at our maximum employment goal, the US labor market remains healthy. Job gains have been solid on average, although through the first 5 months of the year, enough to keep the unemployment rate steady at 4.2% in May. That low level is similar to readings over the last 12 months. The hires rate has also been steady over the last 12 months, and the layoffs rate remains low. On inflation, we've made good progress, but we have some distance to go before we sustainably reach our 2% inflation objective. Headline PCE inflation was 2.1% through April, and estimates from the Cleveland Fed suggest that PCE inflation stepped up to 2.3% in May. Core PCE inflation, which excludes the volatile food and energy sectors, has been running somewhat higher. The Cleveland Fed calculates several alternative inflation measures that help capture the inflation trend, including the median CPI, trim mean CPI, and median PCE inflation. These measures have also come down from their highs, but are still running above levels consistent with our inflation objective, as they have done for the past 4 years. While the recent inflation data have been encouraging, they are backward-looking and may not capture very recent developments. The tariffs that have been put in place have clouded the future paths of employment and inflation. Although I include government policies holistically in my forecast, trade policy is the main focus area for many business leaders. The ultimate extent and size of the tariffs are uncertain, but current information indicates that the average tariff rate will be the highest it's been in nearly a century. It will take some time for their overall economic effects to become clearer in the hard data. That's one reason why I'm relying heavily on feedback from regional business and community leaders in the 4th District. In general, our contacts report subdued economic activity. In their comments to us, many indicate that they have paused some spending in light of increased uncertainty surrounding government policies, including those on tariffs, immigration, and federal spending. While low consumer sentiment has not yet shown up in the spending data, 4th District retailers expect that customers will pull back when prices rise from the tariffs. In addition to the feedback from district contacts, I'm considering a variety of data beyond the usual monthly and quarterly indicators to inform my views on growth, inflation, and the labor market in this dynamic environment. Regarding consumer prices, some high-frequency retail price data indicate that the response to tariffs has been modest so far. However, recent Fed research finds that tariffs on goods from China affects prices fairly quickly, with substantial variation in the degree of pass-through across products. In developing my views on the outlook, I find it useful to think about specific goods, given variation in tariff rates across products and countries of origin. For example, a 25% tariff on steel and aluminum was in effect in mid-March, before it increased to 50% earlier this month. Between February and May, the producer price index of steel mill products increased 21%, suggesting that pass-through can take at least a few months and that further price increases could be in the pipeline. As I noted, the 4th District has historically been a major steel-producing region. To assess the impact of this specific tariff, I've been speaking more frequently with our business contacts in the steel industry. Recently, contacts have noted that demand for domestic steel has been soft. They've pointed to a number of factors for that softness, including tariff uncertainty, concerns about the economic outlook, and a pullback in orders after a surge in steel imports earlier in the year. With the new tariffs in place, there is some discussion of whether businesses will need to rethink their import orders, and many clients are placing orders no more than a week ahead. As this one item illustrates, even known tariffs can impact businesses in dynamic ways. I also keep a close eye on layoff measures, which provide near real-time information. These are broadly stable of late. Initial unemployment claims have been edging up since April, but remain low. Staff at the Cleveland Fed compiled data from advanced layoff notices filed under the Worker Adjustment and Retraining Notification Act, or the WARN Act, that are a leading indicator for layoffs. This indicator moved up in May, but remains near its historical average. Unlike Phil Connors, who yearned for anything to change in his continuous day, I have to say that I welcome the consistency and resilience of the US labor market. Finally, I monitor financial conditions to assess their impact on households and businesses. Here, I've been struck by the disconnect between financial markets' apparent optimism on government policy developments and the more cautious sentiments expressed by many business contacts in the 4th District. Major equity indices have retraced their declines following the partial reversal or postponement of tariff announcements. Similarly, long-term interest rates increased sharply after the initial announcements, but are now only modestly above levels from late March. Differentials between US Treasury yields and sovereign bond yields abroad have widened as some central banks continue to ease policy, yet the dollar has depreciated against a basket of foreign currencies. Geopolitical events have recently put upward pressure on oil prices, which bears watching. While the expansion of oil production in the United States means that the economy is less exposed on net to oil price fluctuations than it once was, there is plenty of evidence that the pain of large increases in energy prices still weighs on consumer spending. As investors weigh the implications of changes in government policies, policy uncertainty, and geopolitical developments, I am watching financial market developments through the lens of a policymaker and looking for impacts on the real economy and inflation. If long-term rates stay elevated, it means higher borrowing costs for households and firms. If the weakening in the dollar persists, it can add pressure on consumer prices on top of the direct effects of tariffs. Rising oil prices could affect inflation and growth prospects. Taking on board all of the recent data and developments, I supported last week's decision to hold the federal funds rate steady. In my view, the current policy stance is only modestly restrictive. The labor market has been healthy, and inflation has come down only slowly under the current setting. This feels to me like policy is already close to neutral. Given the resilience of the economy thus far, the risks from maintaining the current policy stance appear low, and I don't see a weakening in the economy that would merit imminent rate cuts, though I remain attentive to that possibility. Looking ahead, if both sides of our mandate come under pressure, then holding the policy rate steady for some time may be the best choice to balance the risks coming from further elevated inflation and a slowing labor market. If this scenario comes to pass, then it will be important to ensure inflation expectations remain well anchored while assessing the likely magnitude and persistence of the misses to each side of our dual mandate goals. In terms of inflation, it's certainly possible that increases in tariffs could have only a short-lived effect. But coming after an extended period of elevated inflation, consumers and businesses may respond differently to this event than might otherwise have been the case. Additionally, recent increases in oil prices pose an upside risk to the stability of inflation expectations, given the typical relationship between increases in gasoline prices and inflation expectations in the United States. When clarity is hard to come by, waiting for additional data will help inform the path ahead. It may well be the case that policy remains on hold for quite some time before the committee initiates very modest cuts to return policy to a neutral setting. An important role for monetary policy is to promote economic stability. In times of great uncertainty, promoting stability might mean moving slowly, but when there is clarity in the data, promoting stability could mean moving with speed. Consider a scenario in which the economy falters and inflation declines. In that case, it may be appropriate to ease policy by lowering the federal funds rate from its current level, perhaps even quickly. In another scenario, the labor market could remain healthy with inflation moving up persistently. In that case, the federal funds rate may need to be higher than expected to put continued downward pressure on inflation. Fortunately, with the Fed funds rate at its current modestly restrictive level, I think we're in position to carefully assess the incoming data, the risks to the outlook, and the appropriate policy response to achieve our longer-term objectives. I would rather be slow and move in the right direction than move quickly in the wrong direction. Unlike in an American rom-com, I see no neat and tidy way for monetary policy to make a 93-minute exit from its current holding pattern. Until we get to that moment, I appreciate that hearing me repeatedly say that we need to wait for more data must feel like your own version of Groundhog Day. Though my words may sound the same to you, like Phil Connors, I am living each day differently, scrutinizing the data and learning how regional leaders are changing behavior in this uncertain environment. I am confident that one day, though it may not be soon, we will wake up to find more confidence in the outlook, clarifying the path forward. When we do reach that point, know that I am ready to move decisively to ensure the FOMC delivers on its dual mandate of maximum employment and price stability. Thank you.
Thank you for inviting me to speak today, as this gives me the opportunity to set out my latest thinking in the light of last week's decision by the Bank of England's Monetary Policy Committee. The MPC decided by a majority of 6-3 to leave bank rate unchanged at 4.25%, and I was one of 3 members who preferred to cut bank rate by 25 basis points. I'm tailoring my remarks today to try and fit into the 15-minute slot, but you can read slightly longer remarks and see all the charts online. Now, over the last 8 meetings, a year in MPC terms, we've gradually eased policy restrictiveness in the UK, cutting bank rate 4 times, reflecting the progress made in the disinflation process to bring inflation back towards the 2% target sustainably in the medium term. The persistence of domestic inflationary pressures has been our key focus. Since the start of 2025, we've stressed that we're taking a gradual and careful approach in light of the increasingly uncertain global and domestic environment, which is leading to two-sided risks to the outlook for inflation. Today, I want to set out how my thinking has evolved, building on a speech I gave in South Africa in February. I'm going to focus on the labour market, since notwithstanding all the global events, that's where I judge the most material developments have been in recent months. Although the MPC's focus on uncertainty has increased recently, uncertainty is not a recent phenomenon. Chart 2 shows it's picked up sharply again in the last year, driven in this most recent episode by trade policy uncertainty. Uncertainty is typically thought of as widening the probability distribution of future events, making it harder to forecast what will happen next. More recently, unpredictability has entered the MPC's lexicon to refer to events that are unforecastable based on past experience. And the MPC, like many, has employed the term with regard to the recent shocks to the outlook for the global trading system. Increasing uncertainty and unpredictability is also a key driver for us at the bank for progressing our response to the Bernanke review. Now, notwithstanding the prevailing uncertainty and the unpredictability of events, the main aggregates in the MPC's baseline forecasts for GDP, inflation, unemployment, and spare capacity have actually not changed much so far this year, as shown in Table 1. Underlying growth in GDP is forecast to continue to be weak, in part because of restrictive monetary policy. A hump in inflation is forecast for the remainder of this year. Inflation falls back through 2026 and returns to the 2% target in early 2027. A margin of spare capacity or slack opens up and unemployment rises to 5%. Obviously, we will of course publish updated baseline forecasts in August, which will have to take account of the rapidly moving geopolitical developments in the Middle East. Now, given the relative stability in the baseline forecast, what is it about the outlook that has influenced my thinking? The short answer is accumulative evidence of a continued material loosening in the labour market. As a result, while I still think the risks to inflation continue to be two-sided, I'm now attaching more weight to the downside risks in the medium term. Assessing the state of the labour market has been challenging in recent years. And as a consequence, we've increasingly examined the trends in a wide range of labour market indicators. And I want to use the next section of my remarks to set out my latest assessment in three parts. First, what we're seeing in terms of labour market quantities. Second, what we can glean from flows data. And third, what's happening on the nominal side of the labour market. The vacancies to unemployment VU ratio has become our primary indicator of conditions in the labour market. As shown here, the VU ratio has come down significantly from its peak in mid-22, with the majority of the move coming from falls in vacancies. We tend to use 2019 as a comparison point for the state of the labour market, given domestic demand and supply was seen to be broadly in balance. And relative to that pre-COVID reference point, the VU ratio is now materially lower. And as vacancies have exhibited an upward trend over time, bank staff have estimated an equilibrium VU ratio, also shown here. And the difference between the observed and equilibrium ratio, the VU gap, gives a measure of the degree of slack in the labour market. In the last couple of years, the VU gap has shown a reasonable correlation with bank staff's estimates of the output gap, as shown in chart 4. And on that basis, the VU gap suggests that a degree of economy-wide slack has now opened up. This loosening is also increasingly apparent from the employment numbers. The latest PAYE data for payrolled employees, notwithstanding the potential for revisions, indicates that private sector employee numbers are now clearly in contractionary territory, as shown in chart 5. Growth rates in the public sector are also falling back. Retail and hospitality, the sectors particularly impacted by the national living wage and national insurance contributions increases in April, have fallen particularly sharply. The bank's agents' measure of recruitment difficulties and the REC survey, which has been a pretty reliable indicator of the VU ratio, points to some further loosening in the pipeline, as shown in chart 6. All that said, it's important to stress that what we're seeing in terms of the outlook is a sustained cumulative loosening rather than a more abrupt weakening. The redundancy rate and notifications have picked up only very gradually and remain at a very low rate, though the notification series shown in the left-hand panel of chart 7 does not cover the smallest businesses. A potential leading indicator of a more material increase is the rise in Google searches for redundancy, shown in the right-hand panel. Turning to the LFS-based flows data, I'd like to start by recognising the ONS's efforts in reintroducing these data series, which help inform understanding of labour market dynamics. Although it's important to acknowledge that the relatively slow sample sizes, while rising, mean we shouldn't overinterpret what we take from these data. With that said, I'll just draw out what signal we can take from the inflows to unemployment, the separation rate shown here, and the outflows from unemployment, the job finding rate. Typically, at the start of a more pronounced downturn, there would be an uptick in the separation rate as workers become unemployed. In parallel, outflows from unemployment typically tick down slightly from the start of a downturn. Chart 8, with the job finding rate inverted, suggests initial signs of that process re-emerging over the last year. If the recent trends in flows persist, then we may see signs of a more substantial weakening in the labour market emerging, which would risk unemployment rising more over the next year than in the MPC's baseline forecast. So what are the implications for the nominal side? The private sector regular average weekly earnings data does continue to be volatile, but the April reading of 5.1% was below our recent forecasts, as shown in chart 9. This follows the concerning pickup in AWE growth rates in the second half of last year. Our indicator-based model estimates didn't take too much of a signal from the pickup, but the previous downward trend in wages did level off. Given these uncertainties, the MPC anchored its expectations for earnings to the bank's agents' pay survey, which has had a good track record of predicting actual pay settlements. That survey was consistent with settlements falling from 5.4% in 2024 to 3.7% this year, which would be approaching rates consistent with the MPC's inflation target. The latest intelligence from the agents has continued to suggest average pay settlements for 2025 of 3.5% to 4%. And further encouragement comes from the banks and Brightmind settlements databases, which point to actual settlements since the start of this year in a range of 3% to 4%, although the sample is still partial at this stage. Headline CPI increased to 3.4% in May from 2.6% in March. So we are now seeing the hump in inflation we'd been expecting. The headline CPI number was in line with our short-term forecast for Q2. This shows inflation peaking at 3.7% in September, before easing back to around its current level by the end of the year. The main components of inflation are on different paths, as shown in the chart. I've previously drawn attention to the extent to which we can draw conclusions from these components, noting that the degree of symmetry in the respective rise and fall of each wave gives a gauge on the extent of inflation persistence. The key services ex-rents disinflation process is now clearly slower than in its earlier inflationary phase, and at 4.4% the level is uncomfortably high. It will stay elevated in the short term due in large part to the effects of various administered and one-off price increases. But given the high labour intensity of services, the increasing evidence of a loosening in the labour market should continue to provide a disinflationary impulse. Turning to the other components of the CPI, rents inflation, having stayed stubbornly high, has finally started to fall and relatively steeply. At the same time, what's clearly evident from the chart is the pickup in food price inflation, shown in blue, from the middle of last year. At 4.4% in May, it was above our forecast, and the level of food prices is now 36% above the level 4 years ago in spring 2021. This is significant because there is some evidence that food prices are particularly salient for households' perceptions of and expectations for inflation. Core goods price inflation, shown in purple, has remained subdued, tracking slightly below our short-term forecasts. To complete the picture, even before the latest geopolitical developments, energy price inflation was close to turning positive again in May, after the best part of 2 years in negative territory. When weighing up the risks to the inflation outlook as they've evolved in 2025, I've focused on two qualitative scenarios for weak demand and weak supply. To more systematically address the mechanisms underpinning the main risks, bank staff developed two quantitative scenarios which we included in the May MPR. In the staff's weaker demand scenario, uncertainty played a bigger role than in our baseline forecast, weighing particularly on investment, but also on household saving, and leading to domestic inflationary pressures fading more quickly. In the weaker supply scenario, the current hump in headline inflation led to additional second-round effects and more inflation persistence, underpinned by less loosening in the labour market and amplified by weak potential productivity growth. For the purposes of my remarks today, the main evolution in my thinking is to put more weight on the mechanisms at play in the weaker demand scenario, which will be reinforced by the risks of a significant loosening in the labour market. Now, I remain alive to the risk that we will not see the recovery in productivity envisaged in the MPC's baseline forecast. And I'm not ruling out that the wage setting process has become less flexible, for example, through wage setting having become less contestable. Nor am I ruling out that mismatch may have become more pronounced in certain sectors. We'll need to stay vigilant also about the changing composition of inflation and the risk that rises in the most salient parts of the consumer basket, food and energy, increase the chances of second-round effects from the current hump in headline inflation. Similarly, the MPC needs to pay close attention to any evidence that the later stages of the disinflation process, whereby lower wages growth feeds through into lower services price growth, is stalling. These are all plausible considerations, but in my assessment of the risks to meeting our inflation target in the medium term, they've been outweighed by the cumulative evidence across a wide range of indicators of ongoing labour market loosening. In terms of the MPC's June decision, I assess that the signals from the labour market provided a sufficiently strong case for a reduction in bank rate to 4% to guard against the increased risk that in the medium term, inflation would settle at below the 2% target. Given the myriad uncertainties relating to global developments, but also the UK outlook, any policy approach has to be robust to alternative states of the world. Before finalising my vote, I challenged myself on whether sequential cuts in bank rate in May and June would be appropriate if it subsequently became clear that risks to inflation were actually weighted to the upside. It was a finely balanced judgment for me, but I concluded that my approach was robust for two main reasons. First, because even at 4%, I assessed that monetary policy would remain clearly in restrictive territory. So if evidence emerged that pointed to higher inflation in the medium term, then bank rate could be held higher for longer than would otherwise be the case. Second, given the environment we're operating in, I think it's important that monetary policy is outlook dependent and should respond and be seen to respond when the evidence on the outlook requires it. I continue to take a watchful and responsive approach to setting policy. I think this is in line with the emphasis the MPC puts in its collective communications on policy not being on a preset path, and that we will consider the degree of restraint which is required from meeting to meeting. I see no inconsistency with my latest vote and the MPC's gradual and careful approach to the withdrawal of restrictiveness. This has served the MPC well over the last year as we've cut bank rate 4 times by a total of 100 basis points in total. And I believe it will continue to serve us well in these times of increased uncertainty and unpredictability, as long as the disinflation process is judged to be continuing in order to return inflation back to the 2% target sustainably in the medium term. Thank you very much.
So let me thank the organisers from Barclays and the CEPR for the invitation. And as was already indicated, there's a kind of persistence component. Once you set up an event that kind of gains a certain track record, then it's self-reinforcing over the years. So, I'm happy to take my turn coming to this. You've heard, obviously, from the Federal Reserve System and the Bank of England. And of course, over these years, there's been many commonalities across central banks, but also some differences. And maybe you will pick up some differences as I go through my remarks. And essentially, the title of my remarks are basically that that I think now we have new challenges for ECB monetary policy. So since the inflation surges of 21-22, and by the way, I always try to say surges because what happened in 21 is different to what happened in 22. And we had these sequence of shocks, which was quite relevant. But it's been clear. So once we started to respond, the target has been, let's get return inflation to our target in a timely manner. So that's been the phrase we've used a lot. So what this led to, and here I just refer to interest rate policy, of course, the balance sheet policy has also moved, is we had a fairly rapid hiking cycle just over a year, from July 22 to September 23. So 450 basis points in just over a year. Then we went into a hold at peak phase. So we stayed there between September 23 and June 24. And then June 24 until June 25, in the vast majority of meetings, we made a 25 basis points cut. So we've had a gradual reversal of the restrictive stance. And this gradualism in the easing phase reflected the ongoing uncertainty about the speed of disinflation. And you've heard already from my colleagues, essentially in a world of uncertainty, it's not gradualism all the time. In the upswing, we had to move more forcefully, but in this reversal period, it was definitely a gradualist approach. So where are we now? Headline inflation is currently around the target, but what we always emphasize is that we want it to be around the target on a sustainable basis, not just because there's energy deflation. So we've focused quite a bit on whether services inflation is going to arrive at a level consistent with overall inflation being at 2%. And in that case, that's not over. There's still some distance to travel in relation to services inflation. But it's probably fair to say we have enough confidence in what's happened and what we think is ahead of us in terms of services inflation, that for me, that backward challenge, bringing inflation down from the peak back to target, I think is largely completed. So, of course, in principle, that could have been a situation where you come back to round 2 and you say, okay, now we can put our feet up. But there are new challenges. But maybe before I go to the new challenges, let me just go through why we think the remaining services disinflation is, I think, has a high credibility. And I appreciate that's not true necessarily in all jurisdictions. Well, number one, going back to what we've seen in the last couple of years, is that the forecasting process has worked out quite well. That essentially, and that gives a lot of confidence when essentially the forecast of how do the different components adjust in the wake of a high inflation rate. Of course, service inflation moves more slowly because the wage catch-up is a slow process in some European countries. But over time, essentially, repeatedly, the forecasts have really come in on track. And then secondly, when we look forward, some of this was kind of connected to the high inflation rate. We had to look around more deeply to find forward indicators of services inflation. But some of it are basically the value of having soft data surveys. I mean, Beth earlier on talked about talking to firms. We talk to firms quite a bit. We convert that into what's kind of a very contemporary terms called a corporate telephone survey, where we kind of try and convert those qualitative indicators into a little bit of a kind of systematic assessment. So whether it's in our surveys or in the wage tracker data, a lot of it is saying there's more wage deceleration to come. And in turn, that wage deceleration will lead to another wave of declines in services inflation. And again, there's pros and cons to having a lot of multi-year wage contracts. But in terms of forward projecting service inflation, it's helpful because we already know what many people have agreed to in terms of their wage settlement, not just for this year, but also for next year, and in some cases beyond that. So if we, on a backwards basis, are comfortable about being in a good place, the forward issue is what's next? What are the new challenges for the ECB? And I think what's important is we're around the target. We don't say we're going to be at the target continuously, but what we want is if there's a new kind of shock which leads us away from the target, that our monetary policy will be responsive in returning inflation back to target in a reasonable time frame. And so it's really about protecting the medium-term target in a world of volatility. And I think that volatility in part relates to policy uncertainty about the future of the international trade system. Of course, many discussions about the calibration of tariff regimes. That's definitely lots of energy on that. But of course, when you look around the discussion, there's also the possibility of a broader set of non-tariff barriers. The possibility that there's more of an intertwining of economic policy and security policy. And also the possibility that there could be maybe some revisions to the treatment of foreign portfolio investors and foreign direct investors in different parts of the world. So what this means is, I think, I'll come back to. But let me say, one element is policy uncertainty. Behind that, of course, there's also geopolitical uncertainty. So whether that, from a European perspective, is Russia's unjustified war against Ukraine, and the, of course, day-by-day, evolution of the tragic conflict in the Middle East. This is a not saying independent source of uncertainty, but interconnected. And we've seen high volatility in energy prices and also substantial currency repricing. And at least in some periods, we've seen a lot of financial market volatility. Now, there are challenges here for monetary policy, but what's clear in a European perspective, it's also led to a significant change in the fiscal outlook. And again, that's partly a causal endogenous response to some of the policy issues. And from a euro area perspective, it looks like fiscal deficits will remain above 3% over the projection horizon. And then maybe that's quite different if you go back a couple of years about what people were speculating the second half of the 2020s would look like in terms of fiscal adjustment in Europe. On top of that, it's important not just to look at what's currently being talked about and to remind ourselves that underneath the latest discussion, there are multi-year structural changes happening that we have flagged before, but which are not going away. This includes the green transition, more and more now, the increasing adoption by businesses of artificial intelligence applications. And also, regardless of the trade policy, it's also true there's an evolution in comparative advantage around the world. And this has implications, again, separately to trade policy. And all of these work not just on the demand side, but also the supply side. So the net effect on inflation and activity, you have to look jointly at those. And the demand implications and the supply implications can work on different timelines, depending on anticipation effects, adoption timelines, and so on. So when I put that together, what does it mean? Is that I'm fairly sure that a data-dependent and meeting-by-meeting approach to making monetary policy decisions makes sense, with no pre-commitment to any particular rate path. Data dependence doesn't just mean looking at the incoming inflation and activity data. A pretty significant part of data dependence right now is the incoming data on policy settings outside the monetary domain. Since learning about what's actually going to be concluded in terms of international and domestic policy regimes are very relevant for inflation dynamics. And as I indicated earlier on, when we look at all of that, the commitment has to be, if we think this is going to lead to fluctuations in inflation, let's make sure these fluctuations are time limited and we come back to target. And so a lot of this was kind of reflected in our most recent decision by the cut rates again in June by 25 basis points. And in terms of looking at the techniques and the methods in preparing that decision, obviously the staff do a lot of model-based optimal policy simulations. We look at many monetary policy feedback rules. And the conclusion was not only under the baseline projections, but also on a wide range of alternative possible future paths for the economy and for inflation, cutting to 2% was a robust decision. And economically, by supporting the pricing pressure needed to generate targeted consistent inflation in the medium term, it helps ensure that what we have in the projection, which is a negative inflation deviation for the next year and a half, that remains temporary. It doesn't get entrenched in the system, which would cause a bigger headache. And by making this cut, it demonstrates that we are following a systematic reaction function. We don't want the outside world to be too uncertain about what is in that reaction function. And it's clear that our policies are aligned with delivering medium-term inflation at 2%. And hopefully, by having a clear reaction function, this helps to underpin inflation expectations and avoids any unwarranted tightening in financial conditions if we deviated from that systematic reaction function. So, as I indicated, we look at a range of policy simulations. Let me emphasize, those policy simulations included a range of trade policy scenarios. They also considered a range of upside scenarios for fiscal policy. Of course, Germany's made decisions, but it's possible other countries may also make decisions over time. So maybe I'll just stop there. Is that what I've tried to convey to you is the new challenges relate to a wide set of risks. In thinking about those risks, I think it's important not only to look at the most likely path for inflation and activity, but also the risks. So exploring how any proposed policy decision holds up under alternative rates, alternative scenarios, alternative sensitivity analyses, I think is important in order to make sure that we minimize the risk of an extended deviation from the target. So let me stop there. Thank you.
So, good afternoon to all of you. President Hammack, Deputy Governor Ramsden, Chief Economist and Executive Board Member Lane, and President of the CPR, Vedder Di Mauro. Thank you very much for your incredibly insightful and clear remarks, and obviously for being here with us today. I'm Silvia Ardagna. I'm head of the European Economics at Barclays. Thank you all for being with us today, even as you are obviously very busy with events going on. I'm very honored to have the opportunity to moderate this panel. And I really want to make this a very interactive conversations among yourselves. So please do comment on your remarks without me even prompting for you to do so. But just to begin, a little bit more than a year ago, when we were doing this event, it is fair to say that there was a very high degree of skepticism among the investors community that both the Fed, the ECB, the Bank of England could bring back inflation close to target without generating a recession. And here we are 1 year after, and we have to acknowledge how successful the central banks that you all represent have been in achieving this task. Now, from where we are now looking ahead, I was really thinking of starting our discussion from where the chief economist of the ECB started, saying that there are differences now between the challenges and risks and starting point that your central banks face in either keeping inflation at target or still bringing up there. So let me start in reverse order relative to your introductory remarks, and let me press a little bit you more just with the first question on what's coming on the policy, on the monetary policy agenda for the next few meetings. So starting with the chief economist of the ECB, it seems to me at least that the ECB has a less complex situation to handle going forward. And that's because at least your forecast for headline inflation shows that over the next 18 months, inflation will remain slightly below the policy target. So my question for you is, what could be the risks or the cost to ease monetary policy further, stimulate economic activity, avoid this even small undershooting of inflation to target? And so is it really neutral, the appropriate policy stance? Could it be accommodative? Or what should we see to go back to a restrictive stance? Thank you.
So sometimes it's helpful to have these phrases like neutral, accommodative, restrictive. But I said in other occasions, they're most helpful when you're kind of some distance away from target, or the economy is some distance away from steady state. So I'm going to resist kind of putting labels on any variation in our interest rates compared to where we are now. I will tell you, and I said this in an interview just before the June meeting, if rates go below 1.5 or go above 2.5, probably I'll say I think rates are accommodative or restrictive. But around this zone, I think there's a lot of wisdom in the work of Orphanides, Volker Wieland, John Williams, and others, who basically say, look, don't obsess about the level, look at the delta. If you see a change in the inflation dynamic, a change in the GDP dynamic, it's kind of you can adjust the interest rate, going back to the idea of having a stable reaction function. So I think my phrasing there was, we're in a zone of cyclical management now. If we see the downside risks to inflation, of course, tiny things we can ignore, but material moves require some kind of, on a risk management basis, some kind of monetary policy response, equally to the upside. So in that cyclical management zone, I'm not saying there's a kind of formula to differentiate material versus non-material deviations. But what is true is we've learned from these years two issues which may pull in opposite directions. One, we have seen essentially some amount of elasticity to not steady state inflation expectations, but essentially expectations 1 year ahead, 2 years ahead. They can move in response to inflation today. We've also learned in the European context that essentially the cost of living drives wage settlements. So if there's a decline in the cost of living now, then that will put downward pressure on wage settlements next year. And it's kind of a formal indexation in some countries. There's pretty close to formal indexation de facto in other countries. And we've seen really over the years, a significant driver of nominal wage inflation is the cost of living. So I can come up with scenarios where there's more persistence in inflation in both directions. And so in the June forecast, we do have inflation come back to 2. But that's embedded in that is monetary policy is guiding the return to 2. It's not some kind of mechanical thing. And that's why, it made sense for us to make that cut in June.
And in terms of the pass-through of headline inflation to core inflation via the cost of living, how much of that has been embedded in the June forecast? Because we have seen a quite decent revision of inflation, headline inflation, but not much on the core.
So I would say, I think for energy prices, I think there's a systematic pass-through to core. It's not necessarily the same in both directions. If you have a massive increase in your energy bill, if you don't want to go bankrupt, you have to raise your price. In relation to a fall in energy prices, competitive forces do mean it will lower prices over time. In the travel industry, I heard one head of an airline basically say, well, this year, our fuel prices are kind of locked in because we hedge. Next year, because we want to gain market share, the lower energy bill will allow us to cut prices next year. And on the exchange rate passes through. It doesn't pass us through, all in one go. It depends how persistent the exchange rate movement is. But again, after 27 years of the euro, 26 years, there's a lot of empiricism about exchange rates, again, not necessarily being identical in both directions. But that's another pretty, I think, solid issue. But we have, essentially a big decline in core inflation coming up, which is supported by energy prices and by the exchange rate. But once those level effects pass through, we want core inflation to remain at a level consistent with overall inflation being at 2%.
Thank you. Let me move to to Governor Ramsden. So in your speech, you were extremely clear on the fact that you put a lot of emphasis, obviously, in your decision on the loosening of the labor market. And now my question to you is the following. You have been clear that you consider not appropriate to stay on this quarterly level of bank rate cut between May and June. But if the MPC continues to be more geared toward this gradual and cautious approach, which means, at least in our eyes, this quarterly rate path, do you think that the MPC at some point could fall behind the curve? And maybe during 2025, what do you see the risk could be that then the MPC would have to move a bit like President Hammack said, speedier, and move to larger cuts than the 25 basis points per meeting to basically do this catch-up? What kind of data would you, for example, focus on to try to distinguish whether we would fall in this scenario or not?
I think it's worth, it's a very good question, but just to clarify a couple of points that you made. Our collective communications have been consistent since the start of the year. It's not gradual and cautious, it's gradual and careful. Some members of the MPC might say cautious at times. Other members of the MPC, like me, might vote for sequential cuts. So the collective comms is gradual and careful, and that matters, I think, because we're very clear in saying that careful is describing that there are two-sided risks. And we will see how those risks evolve. I mean, I was explaining why I remain comfortable with gradual and careful, but it allows for flexibility. I mean, for me, when we've had the cumulative evidence that we've had in recent months that the labour market is loosening, then that enters into my reaction function. But equally, the journey I've been on over the last year, I have to recognise that in the environment that all of us as monetary policy makers find ourselves in, we have to be quite humble. There's obviously a lot going on in the world, but also there's material uncertainty about how the UK economy is responding to the shocks that we've seen. I mean, Philip emphasised the new challenges for the ECB. We're still dealing with the existing challenge that domestically generated inflation, most obviously in services, is not back at target consistent rates. A year ago, just over a year ago, I was making speeches emphasising that, or asking the question, was the UK more of a laggard than an outlier? I actually think in terms of what we've seen in terms of how the labour market has dealt with the shocks, how the second round effects have passed through over the last year, it turned out that the inflation process wasn't as self-correcting as I thought a year ago it might be. So policy has had to stay more restrictive than probably I imagined it would be a year ago. That has helped get us to the point where I think that the majority on the committee think that the domestic disinflation process is continuing, but there are those two-sided risks around that. And so, to your point, we've set out two quantitative scenarios, one of which which I described as weaker supply. It has many characteristics, but they include a slower speed limit for the economy. That would imply less spare capacity opening up. In that world, future interest rate cuts would be slower. But I think the point I've emphasised in a speech I gave in February, and it comes back to what Beth said, I think, is that in a world where the evidence becomes stronger that inflation is actually going to undershoot rather than overshoot the target, then interest rate cuts can speed up. Because, as I said, I still feel comfortable saying that I think that policy is clearly restrictive. It's using Philip's framing, because I think we're with interest rates at 4.25% or 4%, still above any sense of in what the neutral or terminal rate would be. So that would be my response.
And President Hammack, you were more concerned on the inflation side and on the risks to inflation by saying that obviously inflation is still above target. But the way we read the inflation numbers in financial markets, the March, April and May one, they were more on the soft side, particularly if you look at the month-on-month increase and you annualize that. I mean, the last 2 months have been pretty soft, both on the headline and on the core inflation. So in your assessment of tariffs, it seems to me to understand that you think we still need a bit more time to see the pass-through. But how can we distinguish this from a scenario in which maybe corporates do not really have that much pricing power to pass it through to final consumers because activity is weak? And maybe monetary policy is a little bit more restrictive than what you think, to the point that maybe we are on the verge of having to move rather than waiting for more evidence.
Yeah, I think that Dave said it well. I mean, humility, I think, is a core tool for monetary policymakers. It's important that we all step back. We have to make these longer dated forecasts, these assumptions about how we think things will unfold. But it's important to remember that we can often be wrong, and we need to be open to the possibilities of other viewpoints. And so I do believe that we are still modestly restrictive, and only very modestly restrictive. You know, there are a wide range of estimates for the neutral rate in the US that would range from 2% to 4.6%. And so that's a pretty wide bucket that I think would give even Philip some pause around how you distinguish where your policy is. I agree that the recent inflation readings that we've seen over the past few months have been very encouraging. I think it puts us in a core in something like a 2.5, 2.6 type number. But what you have to remember is that the progress that we've made has been very slow. Yes, those newer numbers seem good, and we've seen some progress, particularly in the housing services inflation category, which had been very sticky. And so it's good to see that we're making progress there. I cited the tariff impact in the steel industry because I think that's one of the cleanest tariffs that we have to look at. And when we look at that, you do see that that impact happened, but it's really over a 3-month period of time. You know, if you start with April 9th as the date that the tariffs were effective, we're still not quite 3 months on from when they've been in place. And so I think we do need more time to understand how those are going to play through in the data and what impacts they could have. Now, it could be that it's a one-time price level shift that, you know, economic research would tell you we should look through. But it could be that given the nature of the on-off, some of the shifts, some of the other policy dynamics, it could be that it's more persistent, and it could be that after 4 years of above target inflation, even though we continue to make good progress, that it could be more persistent to investors' inflation expectations. And that's something that, to me, I think bears more watching before we take action.
Thank you. And to the president of the CPR, in the book that you also have a chapter on stabilization policies. And clearly your unintended consequences showed lower real growth, both for the world economy and for the US, and higher inflation. Maybe if what the experts think about this question, right? What's the optimal policy? Are tariffs a one-off price level shift to look through, or should the Fed be more concerned and stay put?
Well, you have heard from the expert central bankers that it's not an easy call right now to make in the different countries and with this amount of uncertainty. The chapter that you are alluding to is written by Giancarlo Corsetti and co-authors, and is based on a model simulation of the impact of tariffs, and they deduct optimal monetary policy responses for the US and the EU. So 2 equally sized economies. And then the question is, what is it that you have to model? Is it a one-sided tariff shock coming from the US into the EU? If that is the scenario, then the US, it is essentially a negative supply side shock on the US with higher inflation, lower growth. And depending on how that is, how those two are working out, it will tend to mean that the US is going to be more accommodative to this shock, whereas in the EU, the shock is a negative demand shock. And so you have lower inflation rates and lower growth, and that's not both are not nice combinations, but it would essentially mean that the EU would then be more restrictive. And between those two, then you have also an exchange rate between the two, and in these kind of scenarios, the euro would depreciate, which would partly moderate this the initial shock. Now, this is just sort of one baseline. There is so much a possibility. There is the possibility of a trade war, of retaliation. It doesn't look like that right now, but we still aren't through with all of this. And then it turns, if it was a full trade war, which they model, then the demand shock on everybody is larger because the growth decline is larger. And therefore, the accommodation of monetary policy on both sides of the Atlantic become more dominant as a strategy. And finally, there is the question of the dollar dominance, and in what currency are imports and exports actually denominated. And in this one, we are still in a dollar-dominated world, and also for the EU, it's true that some of the imports and exports are denominated in the US dollar, and therefore the feed-through from the exchange rate depreciation of the euro would be moderated, and on the other hand, the imported inflation would be higher. So all of those scenarios I've just described have different monetary policy implications, optimal monetary policy implications. Now consider that what we actually observed is not an appreciation of the dollar as predicted, but a depreciation. And that brings in another layer, which is the whole question about trust. It brings in the question of the bond market, the famous bond market.
We will go all there in all these questions.
But that is the answer within the chapter answer to your question is what I said so far.
Thank you. Yeah. There is one policy that maybe we don't discuss enough of the new Trump administration's in market, but that is clearly very important also for the outlook, and that's the immigration policy. But my colleague Mark Giannoni, who heads the US economics research, has done also a lot of work with other people at Barclays on immigration, and I would like to hand the mic to you, Mark, for this part.
Thanks, Silvia. Yeah, that would be a question for President Hammack. Silvia asked about the inflation part, but turning to the other side of the mandate on the labor market in particular, there are of course concerns that labor market conditions could deteriorate somewhat. I was wondering how you are judging the risks to the employment side of the mandate, and in particular, if you get conflicting signals from the labor market. So the immigration policy in particular is one that is likely to limit the inflow of immigrants, limit the growth of labor supply. We might see slowing employment as a result of that, separately from the effect of the tariffs, but at the same time that might limit the increase in the unemployment rate. So in a situation in which we see low payroll gains, but not much of an increase in the unemployment rate, how would you judge this, understanding, of course, that there's huge uncertainty around that?
Yeah, so the shift in immigration policy could have a material impact in terms of how we're interpreting that data. So if you look at sort of the break-even payrolls number that we had needed last year, would have been significantly higher than what we'll need, I think, this year. And so you need to adjust that, and we factor that in as we're looking at the weekly claims data and other numbers. The tricky thing with the labor market is that when it tends to weaken quickly, and so you have to be very attentive to it, and you have to be watching it carefully, as I am, for those signs. Right now, we've had very good stability in the employment side, and when I'm out in the district talking with businesses, whether I'm in Toledo or Worcester or Pittsburgh or all the great cities that we have in the Midwest, what I get is really a sense from business leaders that they worked incredibly hard to find and train workers over the past several years coming out of the pandemic, and they're very loath to let them go. And so we are in this slow hiring, slow firing world where you're not seeing a lot of layoffs, but if you don't have a job, it's much harder to get a job. So the VU ratio is one that we continue to track closely, and we're still running right around our pre-pandemic number. It's come down very significantly from where we had been in the pandemic, but I don't see the labor market as being a source of inflation for the US economy right now. And based on the data that I'm seeing right now, it looks like our labor picture is reasonably stable, partly because of the immigration implications. It could be a barrier to growth longer term, so that's something that we do need to watch, because if growth weakens, then you could see follow-on implications for the labor market as well. But right now, I think the labor market looks reasonably stable and very healthy in the US.
Thank you. Then let's move to, we have already spoken about tariffs and obviously trade uncertainty, but we could end up spending on it the remaining of the panel. I just want to go to a few more aspects of it, and to you, Deputy Governor Ramsden. I mean, the UK has sealed a trade deal with the US, right? It has been one of the few countries that seems to have to be, from that perspective, in a better place. Now, how do you assess for the outlook of monetary policy this deal that has been, at least in principle, and achieved? And do you think that this is reducing uncertainty and providing a bit more clarity around the future, a luxury that the other central banks don't have, or not?
Lots of parts to that question. I mean, yes, we've got a trade deal, and that's good. It's the detail of it is emerging, and as the detail of it emerges, we can model it. I think Philip was talking about the calibration of these things. You can get hugely into the detail, or you can also, keep it at a broader macro level. But the other thing to say for us is that we are principally a trading nation in services. So this trade deal affects some very important sectors for the UK, but we are the second largest exporter of services in the world after the US, I think. So virtually everyone in this room will be working in services. So we have always been in a slightly, even before the trade deal, I think we have to bear in mind that what happens with the UK's trading goods is important, but also as a very open trading nation, what happens in the rest of the world is also very important, and that kind of trade policy uncertainty has gone up sharply, and I imagine it will come back down, and it will be a particular benefit to have certainty for those sectors, but equally our major trading partner by far on goods and services is the EU. So what happens with the EU is going to be very important for us. And whilst, I thought Beatrice was right in the way she, the way I think about the initial impact of the changes in the trading system with tariffs is that it will be a supply shock for the US, and it will be initially a demand shock for the rest of us to a greater or lesser extent. What we learned from COVID, I think in particular, was the importance of supply chains. And even though even for us, we have very complicated supply chains, on the goods and services side, and we need to bear that in mind. So, I also see the risks of significant supply side elements coming through, which would be, that might be more sustained, depending on where the world gets to. And, we've done a deal. There are lots more deals to come. Who knows over what time horizon? But, we are going to end up, we're going through this unpredictable phase at the moment. And at some point, things will settle down and we'll be able to take stock of what the new world trading system looks like. But for now, I think we will, a final point, we stressed last week and we stressed back in May that we're starting from looking at what's going on in the domestic economy. What the uncertainty, the unpredictability in the rest of the world matters, but actually our main focus on the MPC is still what's going on in the domestic economy. And then for some of us, what's happening in the world can be an additional factor to a greater or lesser extent in terms of how the 9 of us are setting policy. But given the risks that I've set out in my speech and my assessment, in the short term, for me, unless there is some very significant news that, as to we've got either more certainty or more uncertainty about the world, about what's going to be happening to world trade, what that means for domestic trade, what the geopolitics remains, I think the focus will stay or the primary focus will be on the domestic side. And again, I think that's a little bit, in terms of the amount of time Philip and his colleagues are having to spend, I think because they've moved on and are looking at new challenges, I think it's they're having to do a different calculation from us at the moment.
And going to the EU, where there is still maximum uncertainty even on what kind of trade deal we have, obviously, as you were mentioning, Phil, the ECB has put out in place a scenario analysis on the potential impact of tariffs, a more positive one, a more negative one of the baseline. We were a bit surprised by the fact that the impact on inflation for these different scenarios was not that large. Can you explain a little bit what's behind these calibrations and why there seems to be at a high level not a big sensitivity of inflation in the euro area to these different tariff scenarios?
Well, I mean, the main variation across scenarios is basically bilateral tariffs with the US. That's naturally limited by the scale of trade with the US. So it doesn't take that much to come to a conclusion where, unless you trigger ancillary extra dynamics, it's going to lead to limited variation. I mean, of course, by selection, people in this room care about central banks. But the main issue about trade policy is the real economy effect, especially in those sectors which are most affected. So just to demonstrate to you that we think more broadly, just before Christmas last year, we put out an occasional paper, which I don't quite remember the title, but it's more or less about fragmentation. And that took a different approach. It basically asked, let's imagine different scenarios which lead to essentially a very large reduction in world trade. There you get big inflation effects, you get really big recessions. So we've covered, but that essentially, I think the main scenario there, if you kind of converted the non-tariff barriers into a tariff equivalent, it's basically a tariff of 150%. So once you get to a tariff level where basically trade shuts down, you break supply chains, then you're going to get much bigger effects. But what we published was what's basically, in terms of the June, the actual discussion. And the actual discussion is it going to be in the baseline the kind of 10% tariff idea? I think for pedagogic reasons, it's important to say, well, imagine a world of free trade where the benign scenario was going back to essentially low tariffs. And then the adverse was the default, which is if there's no agreement, what the US has said, well, without agreement, this is like the 20% more or less tariff for Europe. But again, this is bilateral tariffs. Maybe going back to the December 24 paper, that's the whole world disintegrating. And if the world disintegrates, then you get the supply chain problems that they've talked about. So what I would say, if you're trying to work out elasticities, calibration, I would include that December 24 work, which maybe, because I'm one of the nice parts of this meeting is the collaboration with CEPR. And it's interesting, because you never know when academic research becomes immediately policy relevant. But over the last 10 or 15 years, various people have, which was an academic-led initiative, have built global input-output network models. So the late Emmanuel Fari, David Bacchi, others, in terms of having that global input-output model is so important. And then on the data side, many people scraping the world to put together, realistic, large-scale models, and many CPO researchers involved that. And that essentially takes years to do. So we couldn't have done it within a few weeks of saying, well, okay, now we have trade and trade policy in the agenda. So having the kind of foundational support of the academic world doing this kind of work has been very, very important. I would say maybe, again, for central banks, where you have to think about nominal issues, monetary policy, and so on, you have to think about investment as a channel. Sometimes macro models drop investment because it's just but it's really important to have an investment in those models. And so if you read that December 24 report, on top of these highly published papers, there's kind of add-ons which may not meet the rigor of the American Economic Review, but helps in converting essentially real economy models into monetary models, and there's some impressive applied macro in that.
Can I just say thank you? And you know, CEPR, we are open for business for anybody who would like to join.
So this major, global disintegration, I mean, maybe we try to, is a little bit the sense that we had after the announcement in April of the taxes. And obviously we have seen since then the reaction of the exchange rate that was also mentioned before, but also lots of talks in market about this de-dollarization of the global portfolios. And to President Hammack, you obviously have an extensive experience in finance and capital market. How do you read the exchange rate response after Liberation Day, but more so, how do you think about these talks about de-dollarization, diversification of away from the US dollar for the global portfolios?
I mean, this trend has been going on for quite some time, so it's important to remember that this is not necessarily new. What's new is the correlation shift that we're witnessing. That's really the different piece, the fact that we saw bond yields go up and you saw this depreciation in the dollar. I mean, that was sort of the more notable impact. If you look at portfolios over the past 10 and 20 years, foreign reserve portfolios, they've already dropped pretty significantly in terms of the concentration of US dollars as a share of assets. And so I think that is a trend that may continue. I don't know that there will be another single currency that will replace the role that the dollar has played. It could be that you have more of a basket approach. But I think it's certainly something that's important to watch. We at the Fed do not have the purview of the dollar. That's really the domain of the Treasury Department. But the implications of what markets are doing because it contributes to financial conditions is something that we do watch to understand how those are going to transmit into households and businesses and what those impetuses will mean on that side. So I'm in a room with a bunch of market participants. I'm not going to try to tell you what the movements in the dollar mean. You can tell me, hopefully at cocktails, what you read from that. But it is certainly something that we're attuned to and trying to pay attention to.
And to the ECB side, obviously, in a recent speech, you mentioned both the Blanchard and Ubide proposal, and you also reminded all of us about the proposal you contributed to in 2011 on the creation of safe assets. Do you have any, I would say, cost and benefits of one proposal versus the other? Do you think that both of them could be venues to contribute to increase the role that the euro could have in global portfolios as safe assets?
Okay, so for those of you who are following this, there's this red bond, blue bond idea, which was around during the time of the sovereign debt crisis, but has been recently revived. And one of the reasons why it's been revived now is a lot of the objections at that time are less objectionable now. So in the sense of concerns that there's a massive asymmetries in terms of fiscal risk or macro risk across the member countries was probably prohibitive at the time. So but what remains true is moving to a red bond, blue bond world requires a lot of political decision making to take place, because the common EU debt would need ring-fenced tax revenue against it. To service that debt, you would need to have, clearly backed by its own revenue stream. That requires major European decision making. The alternative approach, which I was involved with at different points of time, which historically was called SPs, European Safe Bonds, but then when we created more on a kind of official footing, the so-called sovereign bond-backed securities, that needs enabling legislation by the Commission, which is drafted. but it does not ask any government in Europe to make a policy decision. It's essentially enabling intermediaries. It could be a public intermediary, it could be private sector intermediaries, to essentially synthesize more safe assets in Europe by essentially purchasing bundles of EU area bonds and then tranching into a senior mezzanine and junior securities. So that's a kind of engineered approach. The upside is it can be done. The downside is you don't have the same step forward in kind of joint political decision making. So there's a pro and a con.
That's maybe to the president of the CPR. You obviously show what the European leader could do to increase the productivity, the growth, the internationalizations of the dollar by deepening maybe the euro, by deepening the single market. I mean, we tend to want to have some positive angles in the markets. Do you think that all these situations will really put pressures on the European policymakers? Will they raise to the challenge and try to get advantage from these de-dollarizations or issues in the US?
Well, it's not only de-dollarization, right? So Europe is, one way to describe it, it is a perfect storm because from three sides, the previous 20-year basis for prosperity is being threatened. One is the energy and security shock and hostility from Russia. Second is the no longer being sure to be able to rely on open markets and China. And now the biggest shock from this year is the no longer being sure to be able to rely on the US, both for security and for other things that you have among friends. And so between all of those, my strong impression is that a lot is changed. Not only when it comes to safe assets, also when it comes to the realization that integration is now an imperative, as much as defense is an imperative. And in fact, relating back to the book, one of the chapters actually makes this in the title. It says Europe has to be economically strong in order to fulfill strategic autonomy, both in economic and security terms. So this is being discussed in a much, much more serious manner. And it's equally true, I think, if we are going to get an expansion of the safe assets, then it is partly because there is a realization that the international role of the euro is not a nice to have, but would be something that we actually want to have. And, but more importantly, there is also already an expansion of safe asset space because there are new challenges and new responses that have been developed. NGEU after COVID was absolutely unthinkable 10 years ago. And so we are really in a different world externally, and I believe we are also in a different world internally. And the different approaches to that, we developed partly also together over many years before you joined the ECB. They were always a response to making the euro more robust. Now it's no longer about making the euro robust. It is about making Europe robust, and that is the bigger challenge.
Can I just add? I think it's important to remember that this deglobalization trend has been in place over a number of years. It's not new to the beginning of this year. It's been in place certainly as we went through COVID, definitely with the war in Russia and Ukraine. And so there have been trends that have been pushing us in this direction. And so this theme of investors kind of resetting their assets and expectations, there had been a significant overweight in markets that built up within the dollar. And so what we're seeing right now is not a move to abandon the dollar, right? I think what you're seeing is a move towards getting towards more of a neutral weight. I think most investors would tell you their portfolios are still overweight dollars and they still see the highest growth potential globally in the US as well. And so I think it's important to put it in context because yes, there are some shifts that we've seen in the underlying numbers, but I don't think we need to be overly dramatic about the trends that we're seeing.
Yeah, we totally agree on that. We call it's the marginal, maybe investment rather than the stock of investment
Right.
is changing houses at a rapid speed. And I think the academic view is also that these shifts might take, decades, right? I think Maurice Hofsfeld has made that clear in many speeches. But clearly the geopolitical situation is posing lots of challenges on the European side as well. And maybe, obviously the UK is not free from these challenges. It's also in the sphere of fiscal policy. And one other, I think, very highly debated maybe topic in markets is on whether the government should or should not change the fiscal rules to be able to have more room to invest in defense also on the UK side. And Governor Ramsden, there are some who really think that it's important that the UK changes the fiscal rules to have tighter fiscal policy at a time where the economy is loosening and the labor market is showing more signs of slacks. But there are others that are clearly more worried about the bond market vigilantes reaction and the potential of having a negative event again in markets like the one that we had in 2022. Now, the question for you is, can you point out a little bit in your view what could be the similarities or the differences, both in terms of the market structure, but also in terms of the macro now versus what has happened in 2022, in a way that could guide investors to think where to stand on this debate?
I'd probably have to give an entire speech to do justice to the question. I mean, unlike... we haven't. It is worth saying that in the UK, we made various decisions. I was involved in them nearly a quarter of a century ago, not to join the euro. So we have our own pretty settled fiscal system. So the sort of debates that the ECB can engage on are a bit different for us. We have a very established structure, and having had to work on fiscal policy every day for 10 years when I was chief economist at the Treasury, I'm quite comfortable for the last 8 years not to comment from the Bank of England. But to your point about, I guess I can draw out a few points about how we look at what's happening in these core markets, and maybe that goes to your question. The key thing that we seek with our very extensive market intelligence function in the bank, when we're doing the monitoring, whether it's for the and the informing of the Monetary Policy Committee up until its announcement last week, or the Financial Policy Committee, which is its round is getting going, and I think its press conference is due to be on the day that the 3-month pause after Liberation Day finishes. So the FPC will have to track things. But what we do with our market intelligence function is, can we explain what's going on, and is it being driven by fundamentals at home or abroad, or is it reflecting market structure issues? Are there worries about market functioning? Are markets becoming disorderly? Clearly, back in 2022, there was both a tension between monetary and fiscal policy. We were tightening. We had started tightening monetary policy. We were doing it forcefully at times, to use a phrase that Philip reminded us of earlier. And the government announced a stimulative fiscal package, and alongside that, other announcements around the role of the OBR and that kind of thing. And the reaction of markets was to challenge that constellation of, and it was the case that we made a monetary policy decision one day, and then there was a fiscal announcement the next day. But then through our market intelligence function, and this is extremely well documented, what happened at the long end of the curve became harder and harder to explain it was the trigger for the developments of the long end of the curve, but then you saw particularly some investment strategies, LDI investment strategies, had to delever very rapidly. That amplified the initial move in fundamentals, and we saw a blowout in 30-year yields that was certainly off the charts in terms of our experience. I mentioned 30-year yields because that is them being a focus is common to then and now. If you look across core markets in the US, in the UK, in Japan, I mean, you hinted at a bit of this, Beth. You can see that 30-year yields have gone up. You've particularly seen a pickup in term premia rather than this being driven by expectations of monetary policy. But from our perspective, we feel that when I get briefings on that every day, what's happened in recent months, what's happened over a longer time period across the yield curve is explicable. That's not to say that the fundamentals aren't challenging in the US and the UK for different reasons. We don't have the growth performance that the US has had, as Beth was just reminding us. We have got debt over 100% of GDP. We've got a government which is very committed to a set of fiscal rules and showed again recently with the spending review how it intends to meet them. But nevertheless, with the fiscal position as is, with particularly the long end of the curve going up, the cost of financing that debt is going up. So that makes for a challenging fiscal environment. But it's happening even with things like the period in early April around Liberation Day. The moves that we saw, they were challenging at times, but the moves that we saw in core markets were orderly, and they remain orderly. So in a sense, that gives me reassurance in terms of the fiscal context I've got to operate in as a monetary policy maker. But it also means I remain very vigilant because fiscal challenges are apparent globally. We've seen recently Japanese, the 30-year rate has gone up quite significantly. So it's really important that we stay very focused on these market performance, market structure issues. But when we look at the move in UK 30 years, for example, or 10 years, since, say, April, we think that a large part of that is because the most liquid market, the US market, has been driving that. So again, I remember back in the autumn of 2022, people were telling us, that's quite an achievement from the UK. You've managed to move the Treasury futures market, the US Treasury futures market. That doesn't happen very often. The majority of what we're seeing at the moment, I would argue, from our analysis, is being driven by the biggest core market in the world. There are some UK-specific factors at times. We stay very vigilant of it. Probably hasn't answered your question in the way you'd hope. But I'd hope, it didn't say anything about fiscal rules, but I said something about what we're looking at.
You would have never been able to tell me whether you were standing on this debate on revising or not revising the fiscal rules. But I would say that one of the traditions of this conference is to leave quite a lot of time for questions from the audience. So we obviously would have a long long list of additional topics to touch upon. We have not touched upon the balance sheet policies, which obviously is a very important topic. We have not touched upon strategy reviews that there are upcoming both at the Fed and the ECB. So, but before going there, if there are no questions from the audience, I really would like to maintain this tradition. And so to open up for the panel discussion with the Q&A session. And please, there are mic, of course, around the room. Introduce yourself and be brief so that we can take 2-3 questions at a time, but we can go toward multiple rounds. Okay, maybe we can start here from the front row.
Hello, thank you very much. My name is Zoran Rade, Point72 Asset Management. I would have one question for the ECB and one for the BOE, if I may. So for the ECB, I was encouraged to hear you talk about risk management and that being a new approach to policy from here on, perhaps, with risk being clearly on both sides, and we can all write down risks on either side of the inflation outlook. Does that, in the current environment, in your mind, lead to perhaps inaction, given the two-sidedness of these risks, or is there lean in either direction? If you could elaborate on that, that would be great. And then, Deputy Governor Ramsden, to you, perhaps a question. You had a very clear assessment of the labour market, perhaps clear-eyed assessment. What differentiates your view of the labour market, if I may ask, perhaps from the other members of the committee that voted for a hold and against sequential cuts last week? Thank you.
Thank you. Maybe if you can pass the mic at the end of the...
Thank you. Thank you.
Really speak.
Loudly. Okay, thank you. Marcus Ringal, MN Capital. I've got a question about the impact of fragmentation of supply chain for all the 3 central banks. My understanding, referring back to the paper mentioned before, from the ECB in December, they were showing an impact that was persistent beyond inflationary impact that were beyond the forecast period of the central bank. My understanding for the ECB that is not included in the forecast, but they included a bit the disinflationary impact from diversion of Chinese exports. Bank of England, I think neither are included, which maybe is reasonable because one is inflationary and one is disinflationary. We don't know where it happened. For the Fed, there won't be a disinflationary impact from Chinese exports, but you will have a supply chain disruption, luckily. But it seems that that is not included at all in the discussion, in the narrative from the Fed, unless I'm mistaken. It's very much about, let's see what happens over the summer.
Thank you. Maybe there to Stefan. I don't know if you have a question. Okay.
Thank you. Chris Crowe from Capula. I just had a couple of quick questions for President Hammack, please. The first is, you sort of referred to policy being close to neutral. I would note that policy is about 50 basis points above the sort of top end of the range of long-run dots in the SEP. So should I sort of assume that you're sort of close to the top of that range, or do you have a kind of shorter-term neutral in mind that's sort of different from a longer-term one? And then the second question, just on housing. We've seen a number of indicators in housing start to weaken in the US. Housing sales have been weak for a while. Housing starts have come off. House prices are declining. Sentiment among house builders is weakening. Some people say that the housing cycle is the business cycle. Do you have any concerns around housing? Is it something you're watching?
Thank you. Maybe we can start answering this first round of questions. Would you like to start from the ECB? There were more
Sure.
questions then.
So I'm not going to draw a conclusion, but I will go through the methods. So as you've noticed, part of our monetary policy statement is we have a risk assessment which, from my point of view, correctly lists out, here's the various risks we're looking at. We don't, most of the time, try to say on inflation, we think the balance of risk nets out to the upside or to the downside. Because I think that's misleading. I mean, it's much better, we're inviting you, just as we do ourselves internally, to go through, first of all, it's helpful for understanding to go one at a time. Okay, let me think about that risk. But then, we have computers, we're able to do combinations. So look and say, okay, let's imagine, take an interesting mix of those risks. And let's run that through and see, okay, under those circumstances, what does our policy decision look like? So what I would say is to say that it kind of nets out to some kind of inaction bias, I don't think that's a kind of universal law of handling uncertainty. And in particular, and I've written, don't remember if this sentence made it into this speech, it's made it into other speeches, which is if you are inactive and then you get a bigger headache to solve later on, then that causes its own problems. But maybe to reconcile this, in a world of two-sided risk, and let me align with what I said earlier about humility, part of that has to be, now I don't think I would have recommended cutting in June if I felt there was a big probability of reversing in July. But there has to be some openness to turning around monetary policy over not that long an interval if the circumstances changes. There is, I think, a penalty on excessive policy volatility. So doing something now to reverse next meeting, not a good idea. But equally, just to say, look, unless we're 100% certain this cut will survive for X amount of months or years, I don't think you can go too far in that direction. If you agree with the basic premise, we see two-sided risks, we're humble, we don't know what the future brings, and we have to be able to say, look, in a coherent way, when we're managing risks means sometimes you do something that turned out to be actually not necessary. But I would say, again, as you look at us, you should be demanding about that are we, evaluating how are we doing that risk management. I gave a speech here in London last November about monetary policy under uncertainty, where I tried to describe in more detail all the different ways the ECB staff and the Eurosystem staff are methodical in analysing policy under uncertainty. And I think we need to use the best risk management techniques we can have. But if there's going to be a kind of gotcha narrative, or you did something that ex post turned out to be not very durable in its decision, I'm going to be comfortable living with that. On the question about, so the December fragmentation paper, it was written indeed to have a kind of long-term perspective. And one of the points going beyond the projection horizon, which I think has been around for decades in this discussion about globalization and inflation, is if what ends up is shorter supply chains, you have a local supply chain. If you get busier, you don't have the option to import inputs from the rest of the world. Then one of the strong messages from that is probably you're going to have more volatility in inflation, because marginal costs would be more volatile. If there's a strong demand, you run up against capacity constraints more quickly. Equally, if you've weak demand, local suppliers can't keep busy by exporting because they're kind of don't have international customers in the same way. And so some of the long-term consequences was essentially that. More volatility in inflation, which I think Rogoff kind of highlighted 25 years ago, Jackson Hole, and Mark Carney also, actually, Jackson Hole highlighted that. And on Chinese deflation, let me emphasize when we think about that, you can look item by item, but it's also important, and the ECB in our modelling has always had this, the decision-making of European firms depends on the competitive pressure from other parts of the world. So it's not just a case of multiply import share by the Chinese export price. You also have to think about, in steel, for example, other areas, the ability of European firms to raise prices when there's kind of the threat of more imports. So, I think we're trying to be as quantitative as we can about that.
Thank you. Shall we go?
Yeah, I'll go in reverse order. So the housing market is something that we definitely spend a lot of time looking at and looking at carefully. I would say that is the one segment of the economy where I hear persistent shortage in labor, whether it's because of immigration or just skilled trades has been an area that's been underinvested in within the United States for quite some time. And so when we talk with builders in the district, a lot of what we hear is that some amount of the disincentive for them right now is the level of rates, and some amount of expectation that rates could be coming down in the future. But equally is the availability of labor and the cost of materials, and that continues to put pressure on the housing stock, and that's putting pricing pressure on it as well. And so if it's modulating some, that's good to hear. We do have, in certain segments of the country, like in Cleveland and in Pittsburgh, the average age of a home that's being sold is something like 65 years old. And so it's actually quite aged, a lot of the housing stock that we have. And so that is something that we're watching carefully, because I think most of the dynamic in the housing market is really about this underinvestment, this sort of structural underinvestment that we've had since 2008 in growing that. You do correctly read, based on my comments, that I am toward the top end of the range of the dot plot that we put out there. So yes, that's why I think we are pretty close to neutral. And then on this question of supply chains, it is certainly a part of what we're thinking about when we think about the impact of tariffs. And when I'm out in the district and talking with companies, we do talk about their ability to rework supply chains. They've all become much more fluid at sort of the nearshoring, friendshoring. But given the universal tariffs applying to both Canada and Mexico, that creates some amount of complexities. And what I hear most from businesses is the current level of uncertainty is particularly high. We have to remember that we as monetary policymakers are always operating in a world of uncertainty. But I do think that we are at an elevated level of that right now. And for them to look at building new plants and bringing manufacturing back, they need to have more certainty, because the payoffs on those investments are like 10 or 20 or 30 years. And so if they think that some of these policies are only going to be in place for a shorter period of time, it may not be worthwhile for them to completely reroute things. And so they're looking at other potential solutions. We hear a number of different ways of companies dealing with this. And I do think, as the chair said in his press conference, it will get paid by someone, and we're still waiting to see where that's actually going. Is it paid by the importers, the exporters, the consumers? Where in that chain, in that value chain, do we really see the tariff numbers showing up?
Yeah, and so on the question of what differentiates my view from the majority, at least three of the majority are speaking today in different. It is one of the. It is a difference of what we have here in the UK than the approach of the ECB in terms of what we publish. So you've got 2 paragraphs from the majority in the minutes with their risk assessment. You've got paragraph from me and my 2 colleagues who voted for a cut, and that's pretty clear. At least I think that does require then for us, when we're explaining our individual votes that go into the actual decision, we probably do have to go further than the ECB in us individually saying what our balance of risk is within the overall risk being two-sided. And I gave not as much space as to my own views as to those upside risks, but when you read the minutes, I think it's clear that as the majority, they do share quite a lot of my thinking on the labour market, but they also see it balanced. And I guess in summary, and this is how the minutes describe it, the majority say there's generally been some greater signs of disinflationary pressures from the labour market, both in terms of quantities and wages, than from developments in domestic prices. So wage setting, my interpretation is wage setting, on track, and with the potential, as I set out, that we see more material weakness in wages as slack builds up. But in terms of price setting behaviour, I guess I'm more comfortable that that's going to feed through. But that has to be seen over time, and that is the risk I flagged, was that later stage of the disinflation process may have stalled, may stall in the future. I don't think that's for me, setting monetary policy today, that's less of a concern. And just on the other question about fragmentation, I would very much associate. Just to your first point, we've looked into all of these factors in terms of the assessment we've done, and we will revisit this now that we have a trade deal. We'll see where the outlook is looking with our major trading partner, the EU. Our biggest single partner is obviously the US, but our major trading partner by some margin is the EU. What's the potential for trade diversion? One thing I would say is, this point about how persistent shocks would be from fragmentation of supply chains, really associate myself with Philip's point about shortening of the supply chain, in terms of leading to more volatility, whatever the new steady state is, and we've some way to get there. And so I would argue there's that kind of, once we know where we're going, then supply chains will get reworked. That transition, I think, will be challenging. And then in the future trading, world trading system, whatever it looks like, then I think more volatility around that new equilibrium is likely. I guess for UK industries, just to sort of pick up on a point that Beth made, that over the last 10 years, they've already had to deal with quite a lot of big changes in their trading relationships. Brexit is the obvious significant structural permanent change there. And you saw from the chart I showed on uncertainty that that was, in the last 10 years, there have been 4 spikes in our uncertainty index, and that was very much one of them. And when you look at the data for business investment over the last 10, 15 years, for the UK, I think you can see, that's a volatile series, but you can see a change in the trend over that, really that coincides. It may be correlation rather than causation, but coincides with Brexit. So I do think that, as well as the effects you get through all the gravity modelling that gets done as to the effects of changing your trade relationships, these investment effects through the uncertainty channel are really material. And again, that's what we're seeing at the moment, I think, with this new bout of uncertainty. We did see quite a lot of investment in Q1 in the UK, which pushed up GDP. But I think that was, front-loading in terms of what was seen to come on trade. And so investment and trade happened before that. But I think the outlook for trade, the outlook for investment is one of the things that is both going to subdue growth in the UK and subdue productivity. That said, we've just had the government putting out its industrial strategy, which has very much a focus on trying to give more focus to key comparative advantage sectors. So we will see.
Fantastic. Let's take other few questions. Okay, Stefan Gerlach here on front, and then I know we have many questions, but I think I won't be able to get to all of you. So be as short as you can, please.
Thank you. I'm Stefan Gerlach from EFG Bank. I'd like to ask you about your views now on conventional monetary policy. And let me motivate that question. So SNB Chairman Martin Schlegel said last week that the bar for the SNB to reintroduce negative interest rates had risen. And so I'm wondering, looking back, do you think views among central banks about unconventional monetary policy, negative rates, forward guidance, QE, have changed? Or do you think they feel that perhaps not all these policies were so hot as they looked at the time. Thank you very much.
Thank you, Stefan. So on the back, if you don't, send the mic here to first, and then can we get a mic there for the next set of questions? Back. Okay, go, Jackie. You just had to speak.
Hi. Thanks, Sylvia, and the panelists for the very interesting discussion. Jacques Caillou from Agave Capital. I just would like, the question goes to Beth on maybe double-clicking on the recent price developments. You mentioned pass-through on steel, but I'd like to have a little bit more of your understanding based on the anecdotes that you've seen over the last perhaps 6 weeks in the way that inventories of previously purchased goods are being run down and how this is impacting, if at all, the pricing policy of consumer goods as you see them. Thank you.
Thank you. Back there. Okay, who has the mic? Cesar, do you? Yeah, okay.
Thomas Filadek from T. Rowe Price. So I have a question on the balance sheet for each of the 3 central banks. So obviously everyone's doing QT now. Now, I guess what I would like to know is how big do you think the effects of QT on financial conditions in your respective regions have been thus far? And how do you incorporate those effects in the monetary policy rate decision?
Okay, let's take another one. We have Cesar here. Yeah, and then please get a mic over there. So we'll take all the 5, and then that will be the last one. Yeah. Okay, Cesar, go.
Cesar and Baliasny. I've got a question for Beth in particular. Last month, you said you were hearing from businesses that there were some that were raising prices even though they weren't directly impacted by tariffs, just because competitors were doing so as well, which indicates pricing power. And you also mentioned that firms under uncertainty were likely to raise prices only gradually, which again is a sort of risk to the idea of an immaculate sort of one-off price increase. Are you still seeing those kind of feedback and trends, or has anything changed?
Thank you. So back over there was last one. Okay, and
Hi,
then
thanks.
we'll give the.
So just a couple of quick ones for Dave Ramsden. You mentioned that 4% is still in restricted territory for bank rate in the UK. We just wondered if you know what your neutral rate is, if you know that 4% is restrictive. And the governor has been speaking in the House of Lords today, and he was talking about quantitative tightening and the decision. He said the decision on QT is going to be more interesting this year because the yield curve has steepened. I just wondered if you could expand on the Bank of England's thinking on that particular comment.
Thank you. Maybe we can start in reverse order, and then from Dave, but you pick and choose, because we only have 7 minutes, so maybe we go short also on the answering side this time, unfortunately.
That suits me. I mean, all the questions to me, I think, were, well, apart from Phil's other question, were relating to the balance sheet, and some questions on QE as well as QT. I mean, look, I guess the point, and look, with bank rate at 4.25%, we're in a very different position from Martin Schlegel in thinking about these issues. But, you know, it's important to keep revisiting what we did and what we've learned, because there's no reason why it shouldn't be relevant again in the future. And I mean, I guess the point I would make, and it then links to the QT questions. The last time we did a lot of work and contributed to this was about a couple of years ago, when the Treasury Committee ran an inquiry on quantitative tightening. That's a different committee from the one that Andrew Bailey is in front of. That's the Commons Committee. And we tried to stress then, and I think this really is important. I mean, it doesn't really answer your question, but it helps frame it. The kind of state dependency and state contingency around both the use and then the impact of these tools. So I think we would acknowledge now that, for example, going through the COVID period, where we went big and fast in March 2020, which was also at a time it was needed on monetary policy grounds. I can see two of my colleagues who are around there in the second row. But it also, given how dysfunctional core markets were at that point, the impact of that bout of QE was probably more significant than, say, the final bout, the final amount that we did, the 150 over nearly 12 months at the end of that year. That first was a 200 over a much shorter period. I won't say any more than that now, but these are still live issues. In terms of, we should be continually challenging ourselves. And, back to what Beth was saying in her remarks about, speak, listen, and learn. We learn and listen to what other central banks are doing and experiencing. And so obviously the Swiss National Bank is where it is now, and so is considering these issues. On QT, very quickly, QT is obviously done in very different circumstances. It's in the background. The impact of it, when we last assessed this for last summer's decisions, or we did the assessment over the summer, we made the decision in September, was that QT is still having a modest impact. The way that we do it, by making the decision in September and trying to do it in as gradual and predictable a way that markets can take account of it, means that it should be, for us, priced into the yield curve. Then when we come back to make our decision on our primary instrument bank rate. So that's the way we think about how do we factor it in. And we're about to start that process for this year. So Phil Aldrich wouldn't expect me to say that, I couldn't possibly really better the comments that my governor made in the Lords this afternoon. I mean, it is, though, always an interesting process and discussion, because it's an important part of what we're doing. We've set out very clearly the role we think it plays. I did say earlier that movements at the long end of the curve were a particular focus of us more generally in the bank, so I think that's consistent with what Andrew said. And I think you can conclude, when we did some work on R-star, global R-star, back in February, we said that the range for us, Claire said this at the press conference, the estimate suggested that global R-star could, anywhere between 2% and 4%. That is a really quite wide range. From what I've said to you today, I think that we're still clearly in restrictive territory, even if we have bank rate at 4%. So I'll leave it at that.
Great.
Okay, so on the balance sheet, I gave a long speech about my views on the balance sheet at the end of February, so I'm going to channel my non-inner PhD economist and tell you to go read my speech if you want to know what I think about the balance sheet. On inflation, we are hearing, we're not seeing as much direct pass-through in consumer prices yet. There's still plenty of time to see exactly how this is going to play out, and it could be because of inventories and retailers working through inventories that they've brought on. We've certainly heard that in the auto sector, that there was a big pull forward in sales, but that their pricing strategies don't really move until the new cars that they've bought come on the lot. And so I don't know exactly how this is going to play out. This is, again, where humility becomes really important in terms of looking carefully at what we actually see in the data and what we don't see in the data. And if we don't see a material pass-through on the inflation side, that would be a great relief. And hopefully we would continue that same pathway that we've seen of making this steady progress on our inflation goal back towards our objective. But we have to be attuned to the possibility that that may not be what happens, and that it could be these more layering effects because of the way that the tariffs have been announced and put in place could have some of that, coupled with the fact that we've been above our inflation goal for 4 years.
Maybe unconventional policies.
I'm going to use the, I think it's undesirable for me to front run the conclusion of the review. So you will have to maintain your kind of, anxiety or anxiousness to read the review when it comes out, where every possible question will be fully answered completely forever. But let me turn to QT, which is interesting. And again, I gave a speech a couple of weeks ago. The opening months of 22 is a remarkable period. So, of course, we didn't start hiking until the summer. But the adjustment as the world worked out, okay, something's about to happen. There's a very big move in the expectation. What I looked at in the speech is the 10-year. And a very big move in the expectations component, which is remarkably centered on, we think, most of the time your policy rate will be around 2%. And a very big move from a negative term premium to significantly positive term premium. But since the first half of 22, incredibly flat. So what that says is essentially, which is what the models would tell us, is you guys, investors, you forward solve, okay, the market over the next number of years is going to have to absorb a lot more debt because the ECB will step away. I'm going to reprice, but that repricing more or less is front-loaded. And so what we've seen is, of course, over time, there's a gradual reduction in our share of bond holdings, but the yields more or less adjusted on a front-loaded basis. There's a second issue, which more and more I think is interesting, which is basically the liability side. So in other words, as we step back, the amount of central bank reserves falls. But it's still in a very abundant situation now. At some point, this will become interesting. But it's not yet interesting in the sense of we know for sure how the banking system, in terms of its credit policies, its kind of bond allocation policies, how that interacts with a lower steady state amount of reserves. So that remains to be seen. So I think both sides are, and of course, for those of you who study this, a large chunk of our expansion were TLTROs. And that they rolled off pretty quickly. So we had already a pretty big reduction. But when you go from huge amounts of reserves to a lot of reserves, maybe you don't learn so much. It's going to be later on when you get much more to kind of a kind of more interesting zone that we'll learn some more.
Right. We still have a lot to learn, particularly on balance sheet, but we have learned a lot today, and I would like to thank you all for having shared all this immense amount of knowledge with all of us, and for having been so generous with your time. But before going to cocktails, I think it's, I feel I need to also thank your staff for having made this conference possible, because they've been tremendous in working with us. On our side, a big thank goes to Mia, Charlotte, Claudia, and Ben, and on the CPR side to Barbara, Nadine, and Tessa. Without all these people on the background, and obviously all those who are here today, this conference would not have been so great either. So thanks again for your time, and we hope we can do this again next year together with the CPR.